Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, February 4th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. Okay, so the chart that we're going to be working from is a weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading, and this chart goes back to the beginning of 2021, just to give us some perspective. To start off with, the S&P 500 was up 1.55% this week, and we closed at 4,500.53. So the first thing I'm going to do here is, let's bring up the annotation tool, and we'll just do a quick, so we can see this a little easier. 4,500.53 close plus 1.55%. And we will enlarge this just so it's much easier for all of us to see. Okay, so it's going to be important for us to have that information. And now the next thing we're going to do here is we're going to take a look at some support and resistance levels, because it's important to really understand what's been going on. So let's take this horizontal tool, and you can see here where I can move it around. Now, you know, on this analysis, the way I like to do it is I want to see where the bodies of the candles have closed, all right? Because the past trading gives us clues, right? It tells us what's been working and possibly what's going to keep working going forward. So what I want to do here is I'm going to drop this at this 43.50 level, all right? And the reason this is so important is, and I'm just going to go ahead and save that for right now. We can go back into that annotation tool in a second. All right. So 43.50, you can see here what has happened over this, during this downturn. All right. We went down, and obviously the tail of this candle went much lower, and we'll talk about this in just a second. All right. But you can see that the body of the candle, right, and the weekly closes have been above this 43.50 level. Now, going back over the last 6+ months, we can see that this 43.50 level on the S&P 500 has been a very important support and resistance level since clear back in June, right, when we first got up to this. All right, so we got up to this level, stopped, and then we had some trading right around it. We finally got above it. We pulled back towards it. And what I'm going to do here is get back into this annotation tool, because I can hover over this, and we can see in the lower left the close here for this week right here, because it's really close to this 43.50 line. But we can see that the body of that candle closed at 43.57.04. So that's down in this area here. All right, I don't know if you can see it, but 43.57.04 was the close of this candle right here. So the point I'm making here, guys, and I hope you're understanding, and and I hope you're enjoying watching me do the analysis rather than me annotating the chart and then just putting it up here, because I want you to understand how to do this, how to think about this stuff. All right, but because you need to approach the market and be agnostic. In other words, you need to have the you need to have a clear mind when you come and look at this information, and just let the data, let the market speak to you, rather than having some, and this is the mistake most people make, is they have some preconceived notion of what they think should happen, or what the market is going to do, and then they get brain locked, right? They can't get around that. And by approaching the market in an agnostic fashion, in other words, with a clean mind, right? You don't care. You don't have any kind of preconceived idea what you think the market should be doing. You just want to know what the market is telling you, right? The market is always speaking to us. It's up to us to receive that feedback, all right? And this, guys, I've been doing this a long time, and I see that most people, probably 80 to 90% of all traders, investors, make that mistake, from my observation, in that they get some preconceived idea, they have their own personal biases, and they think that the market should be doing this or should be doing that, and instead of letting the market speak to them, they're trying to tell the market what it should be doing. And guys, that never works, okay? It doesn't pay to argue with the market. You're going to lose every time. All right, just let the market speak to you. So, with that said, we can see here that during this downturn, and remember, the weekly closes are more important than any individual daily close, all right? So when we do this analysis using weekly candles, we can see that we had some trading below the 43.50 level, and we'll zoom in and take a look at that on a daily basis here in just a minute or two, so that we can really tell what happened. But we can see that the body of the candle, right, is all above 43.50, and we can see that we closed well above that 2 weeks ago, and then this week again we closed at 4,500.53. Now, if you go back and watch last weekend's video, you'll see that I talked about the fact on, when I was doing the analysis on that week right here, right, a previous week, that I told you I wanted to see the S&P 500 get above 44.50 on a daily basis, and then 4,500 on a weekly closing basis as soon as possible. And 1 week later, I didn't really expect it to be that quick, but here we are, 4,500.53. So it shows you just how important that 4,500 level is, all right? Now, a couple of things I don't like here. I don't like the fact that we closed, right, if we're just analyzing this particular candle here, I don't like the fact that we closed in the bottom half of the week's trading range on that candle. That's kind of ugly, right? But hey, we've had 2 positive weeks in a row. We've held above 43.50. We were up 1.5%. We closed above 4,500. So, all of those, should be viewed as a win. And we did this on above average volume. Another thing you want to watch is this volume, right? If it was a low volume up week, like this week here, it doesn't mean as much, all right? And you can see that oftentimes these low volume up weeks, like this week here at the latter part of December, precede, right? They happen before a downturn like we saw here. So when you see volumes start to, on the upside, start to trail off like this, it sets you up for failure. All right. So look for those types of patterns going forward. When you see the volume trail off on the upside, then you know that the appetite for buying is starting to wane, and you potentially become vulnerable to a sell-off, all right? And that's exactly, obviously, what we saw here, 3 negative weeks in a row. But we've had 2 positive weeks. And look at these up weeks. The volume on these up weeks are actually higher than the volume on these 3 down weeks, all right? And you can see that the volume on the down weeks, right, over these last 5 weeks where we started to sell off from clear back here in the end of November to current, we can see that the volume got lower and lower and lower as the selling continued. All right, so these are clues, right, that the volume is starting to wane, right? It's starting to drop off when the selling is happening, and then you get 2 good weeks of volume to the upside. So again, we're just looking at the data, right? We're trying to be agnostic. We're trying to listen to what the market is telling us. And I know there's a ton of people out there that are negative and they think the market should be doing this or doing that. Guys, I don't approach it that way, right? Because I don't care, right? I just want to know what the truth is. And right now, the truth is that this, based on what we're seeing, right, the evidence is right in front of us. The 43.50 level continues to hold on a weekly closing basis. Now, since back in June, have we had some trading below this area? Yeah. And we had 1 week. We've had 1 week, guys, clear back in July, right here, that has, since the end of June, we've had 1 week right here, right, where you see my cursor moving, that is closed below on a weekly closing basis, that is closed below 43.50 on the S&P 500. 1, right? So that shows, and that tells us, by analyzing the data and being agnostic about it, it tells us just how important and how strong this 43.50 level is, all right? So that does a couple of things for us. Number one, it tells us, hey, as long as this 43.50 level continues to hold up on a weekly closing basis, we're probably going to be okay. But it also tells us that if we start to see weekly closes below this 43.50 level, we've got a problem, all right? Now, the next area of possible support is going to be, as I see it, right in here, all right? And I'm actually going to use a box on this one. Let's just kind of draw a rectangular. And we've got some support right in, it's really the thicker part of this, and it's not near as important. Let's just kind of leave that box right in here. It's not near as important and there wasn't as much trading. But we've, April, May, June, we've got some trading right around here, and that puts us right around the 4,200 level, all right, plus or minus, all right. So we kind of drew that box, and again, when you're doing this type of work, it's not well exactly okay. Well, fortunately, right, we've got the 4,350 level, and that's been pretty rock solid, all right. But you're kind of looking for a range. So in this instance, right, if 40, so now we're looking at potential downside targets. We're looking at this 4,200 area plus or minus probably about 50 to 75 points, maybe even 100 points, right down to this 4,100 level. So and you can see 4,300. If we added 100 points to this, you can see that this 4,300 level, we've had no closes below 4,300 since back here in June. So actually, right here. Okay, so we've had since the middle of June, no closes below 4,300 and one close below 4,350 since kind of the middle of or the first part of July. All right. So this 4,200 level, if 4,350 does not hold, that is the next downside level. Now, unfortunately, and go back, a couple weeks ago and look at my that video, because I did a deep dive and I went clear down to, like Jeremy Grantham is calling for a retracement clear down to 2,500 on the S&P 500 potentially, and I went through the possible scenarios, because is it possible? Of course it's possible, guys. It's always possible to see, go back and look at 2003, 07 through 09. We went down 50, 60% in those drawdowns, all right? So when you get into a serious bear market, right, and you've got earnings decreases and PE contraction, right? Earnings decreases, PE contraction, that's a bear market. You can lose 40, 50, 60% off the top. So, and those things are painful, and they can last well over a year. They can last 2 or 3 years in some cases, all right? So, is it possible? Yes, but based on the evidence right now, that is not what we have right now. What we have is a pullback from peak to trough, and I've already done the math. It was a little over 12%, right? 10% is a correction. So from here to here, we've had a correction. On a weekly closing basis, the 4,350 level, which has been a very important support and resistance level since back in June, that level has held. However, we know from doing this analysis, from being agnostic, from just looking at the data, not having any preconceived notions, we know that if 4,350 does not hold and we start to see weekly closes below that level, then this 4,200 level is, plus or minus probably 50 to 100 points, especially 50 points, right? But it's in this 4,200 level. This is the next area of support. But below that, guys, I can tell you, but please go back and watch that video from a couple weeks ago. We're looking at something below 40, below 4,000, probably 3,800, or plus or minus, if this 4,200 level doesn't hold. Okay, so again, I am not suggesting we're going down to 4,200, but let's also take a look at what has happened, right? Because I want to point this out. So what we're going to do is let's change this real quick here to a daily chart. And let's start there. That'll wipe out our annotations. And let's kind of zoom in here. Now, we know this 4,200 level, and that was April through, and let's just go ahead and leave it on going back to 2021, okay? Because I want to point out something here. Let's go to price labels. We'll go update. All right, so I'm going to draw a circle around this. Right here, right? Monday, the 24th. All right. Monday, the 24th of January, right here, during this downturn, we hit a low of 42.2262. Hopefully you can see this in where I'm moving, but that's what that says, 42.2262. I know the type is tiny, all right? So the point is that we've already, during this downturn, and I pointed out these possibilities a couple weeks ago, right, when I did that analysis, if we put this line at 4,200, and remember I said 4,200 plus or minus 50 to 75, even 100 points, that is exactly what we've already done. We checked back, right, from the high of 48.1862 right here to this drop right here. That's a little over 12%, right? So we've had this correction, and we pulled down to the top of this 4,200 plus or minus level. So we've already checked down to that level, but we successfully bounced off of that and then went right back up. And as we know, we've closed above that 43.50 level on a weekly closing basis for the last couple of weeks. Now, let's shorten up this chart because I want to show you something else. So let's change this to, let's just make it to beginning of September so we can really zoom in here. All right, that should work. All right, so what I want to show you here now, let's get this annotation tool out again, and let's take this 43.50 level, and that's going to be right there. Okay, so what I want to show you here is, and let's even shorten this up to even a shorter term time frame. Bear with me a second, you guys. This is super important for you to understand. All right. Again, we're doing analysis. We're being agnostic. We want the facts. We don't care about somebody's opinion. All right, so we know we have this line set at 43.50. We know 43.50 has been a very important support and resistance level for quite a while. We know that we pulled down to this 42.22.60 level and bounced off of that, right? The buy algorithms, that is the only thing that makes any sense as to why we had this huge candle. We were down over 4% on Monday the 24th, and we bounced all the way back and became positive, right? And it's just the world we live in, guys. 70+% of all the trading in the markets now, and you can look this up on you. Go fact check me, right? Go Google it. But 70+% of all the volume in the markets now is driven by computer programs, algorithms. All right. So these types of moves, these types of extremes are probably the norm going forward. All right. It's never going to go. We're never going to go backwards, right? The genie's out of the bottle. But what I want you to understand here in doing this analysis, and again, I'm walking you through how I think about this stuff, how I do research, how I look at this stuff, right, to get the facts. Because you want to remove the emotion. That's another thing I see most traders, most investors make massive mistakes, which again is why I created Simple Market Signals, and I'll tee up some more information for you at the end of the video, but is why Simple Market Signals is so darn important over and above all of this technical analysis, right? Because it's my proprietary model that I created for myself. Took me over 20 years of research doing stuff like this to figure out the truth, to figure out what works and what doesn't work, and then getting myself focused on the most important data points within the stock market that I can use, a formula that I can use over and over and over again that allows me to understand where certain levels are, right? What the market mode really is. And, but anyway, so what we can see here is we've had two, guys, count them, 1, 2, and I want you to understand this one right here. This candle right here, and again, looking down in this area, hopefully you can see it, but if I hover over this, we can see that the close on, that's January 26th, we closed at 43.49.93. Now think about that for a second, 43.49.93. 43.50 is that important level. So we're talking 0.07 points below the 43.50 level. So we've had two, right, to be completely accurate, we've had two in this entire downturn. We've had two daily closes below 43.50, the 26th and the 27th. Now, we've had trading, right, intraday trading below this 43.50 level, but we've had two daily candles. And this one by 0.07 of a point, 43.49.93 was the close, all right? So 0.07 points below 43.50. I hope you understand the point I'm making here, guys. We've had only two, right, and this one by just a little bit, closes below 43.50. So it just shows you again how important this 43.50 level is, guys. So again, be agnostic, look at the facts, look at the data. What is the market telling you? So right now, the market is telling us that and I'm not saying everything is rosy out there, okay? I'm just looking at the data. But from a technical standpoint, we can see just how darn important this 43.50 level is. And as long as, especially on a weekly, because remember, daily closes are more important than hourly candles, right? And weekly closes, right? Whatever the weeks ended up is more important than what any one day did, right? But when we look at, especially over the last couple of weeks, we just looked at that chart on the weeklies, we know. And even looking at the daily here, we can see how important this 43.50 level is, right? So again, two ways of doing this, right? We know, okay, as long as we stay above 43.50, we're in good shape. But it also tells us that if we start to see, day after day after day, and then weekly closes below 43.50, we've got a problem. And we know that next area to look at is 4,200, and there's not near as much support at 4,200 as there is at 43.50. So 4,200 may hold. So far, we've checked back to the top end of that range at 42.22.62. So any stops that were set in the market, right? Anybody, whether individual traders, professionals, whatever, up to this point that had stops on the S&P 500 down to 42.22.62, those stops have been cleared out. All right. So it's only stops maybe that have been put on since the last 2 weeks, since Monday the 24th. If somebody has stops at 4,400 or 4,300, those might get knocked out on the way down. But but we've cleared these stops. All right. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03, and then next we'll take a look at the bear market that started in 2007 that ended in 09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. And this risk signal, the market mode signal, would have been red through the majority of this downturn and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower. All right. And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased. Okay? Now let's take a look at the bear market from 07 that ended in 09, and you can see here that the risk signal would have turned red right here, right around 1500 on the S&P 500. And you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week, and then the market rolled back over. And so maybe you would have had a small loss here, okay? But that's just the way any type of protective system works, guys. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. Why is simple market signals so important? Because market risk is the single biggest risk most investors face. And market risk is non-diversifiable risk. Market risk cannot be diversified away. And future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Simple Market Signals is built around a multi-factor stock market-based model. I'm going to repeat that. Simple Market Signals is built around, based on, a multi-factor stock market-based model. Simple Market Signals identifies the current level of market risk, giving you the opportunity to stay in sync with the stock market. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice, but this is the feedback that SC from Florida gave me. So I appreciate this. So again, SC writes that Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well-off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the questions. So I produced it just as he wrote it. So the first question, what do you like best about Simple Market Signals? What JV said was, one of the things I like best about Simple Market Signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about Simple Market Signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has Simple Market Signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from Simple Market Signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. There's two major components to the Simple Market Signals proprietary model. There's the risk mode, the market risk level signal, and then there's the general trend indicator. Let's start off with the Simple Market Signals risk signals. The Simple Market Signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits. And this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market and the market is generally sideways to slightly up or down in a yellow signal environment. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Next, let's take a look at the general trend indicator. The general trend indicator measures the trend of the stock market based on our proprietary formula. The signal is either positive or negative. When it's positive, we're in a upward general stock market trend. When the signal is negative, we're in a downward general stock market trend. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green, yellow, green. So you can see that most of the yellow signals go back into a green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018 and what you'll see also in 2020 is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, you know, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about, right? And even most of these yellow signals, this is when we get that pullback, but it gives you confidence in knowing what the market is doing. Now let's take a look at a few charts for the general trend indicator. And just like with the risk signal, we're going to start off with 2018. You can see we came into the year with a positive signal, had kind of a chop here where we went back and forth between positive and negative for a little while in February and March. We had an outright negative signal and then went back into a positive. But you can see here, right, this sell-off that we had in Q4 of 2018, we've already looked at the fact that that risk signal went red, and you can see here that we would have had a negative general trend indicator signal as well. And then you can see here when the signal is positive, this is when you get the most upward progress in the stock market. And this takes us into 2020. Of course, we had the negative signal right here during the COVID sell-off in February, March of 2020. And this takes us again to the end of August, beginning of September of 2021. And you can see here positive, very short negative signal, and then a nice long positive signal. And again, just like with the risk signal, I'm stopping the data at the end of August. And if you want the most current information, please become a subscriber. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. From week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered, okay? So that'll be the occasional bonus material. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card. Enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up, okay? So I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market Signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate, but there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signal. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. So join now to start benefiting immediately from this valuable and potentially life-changing information.